two experts joining us, Jayesh Mehta and Lakshmi Iyer. Both of them are money market and bond market veterans here in India. Jayesh and Lakshmi, thank you very much for your time. Lakshmi, let me start with you. How important, people are calling it a watershed moment, and of course the FIs have started pre-positioning ahead of that event itself. In your view, how important is it in larger scheme of things?
Yeah, hi, good morning. Indeed, it is, you call it by whatever adjective, watershed, momentous. I would say in my parlance, 9 months and a baby is born. So this announcement was made in September of last year, and the consummation is happening finally today. And yeah, it happens to be the 9th month. But the thought process obviously was conceptualized and conceived a long time back. Why is it important? Of course, we've already seen the merits of it. We've seen flows coming into fixed income, and it continues to be unabated. This is just the 6th month of CY or calendar year 2024, and we have crossed almost 65 or 1,000 crores. And that's a big number given the fact that the total amount that came into last year, which is CY 2023, was just about $6.5 billion, which is about 56,000 crores. So I think it's a great, and then of course, it is going to be the second largest weight in the index, only to China. So I think from all perspectives, it is indeed overwhelming and a very, very proud moment for India.
Okay. Before we address that, Airtel also in line with Jio has revised tariffs upwards. But Jayesh, morning firstly, foreign investors have already directed about $10 billion into the securities which were eligible for the index. As the weightage increases to that 10% mark, what is the possible kind of inflows that we could be staring at?
There is some pre-positioning happening, getting into index, plus our currency behaving. So there are two types of investment which has happened, right? One is in preparation for index. Second is India macro looks good. There are a lot of RV trades people have been putting, which is long INR, short CNH, and that's the best way to go long INR is to buy Indian government bonds. So I would not put every government security trade as a preparation for index. It's also a currency play into the situation. But having said that, yes, we will see some steady flow coming for next 10 months as the weightage gets absorbed for the index trader. And this is something as whatever you said, like it's a notable event. The only thing is they should have done it 10 years back. But finally, they have recognized India. So I look at it this way. All the reasons given that we should not be part of index, our settlement and everything is the same. Yes, we did have a far limit increase, but apart from that, nothing really changed. But then I think it's because of India's importance and the way the India macro is changing. I think they kind of got us back, got into the index. So it is like, all last 9, 10 years, the reasons they have been going is the same reasons that today. But then we are getting the second largest weight. So that's the recognition to India. That's a big step I would look at it. So I would look at it slightly differently, just not index inclusion, but it's like recognition with the similar infrastructure. We didn't they had a lot of asks, but we continued with the same setup. We have the one of the best system in the world for settlement, and we continued with it.
Jayesh, I want to talk to you about the impact it could potentially have on cost of capital in India. What are your thoughts there?
So I think medium term, short term, this particular year, yes, as the index flows comes in, because I have a theory. I had a theory like India, the supply was you had three buyers. You always need the fourth buyer, which is the bank, insurance, and provident fund. But last 2 years, the demand supply has been matching. So it's like bank, insurance, provident fund, and pension were matching. So you don't really require the fourth buyer. The fourth buyer earlier was either RBI buying bonds or FPI coming in. Now with index this year, when we have matching demand supply, and on top of it, we have $20 billion to $25 billion more coming in. And on top of it, our fiscal looking better because, of course, not much of the spend has happened till June. So we might see some reduction on fiscal. So therefore, supply would be constrained, and therefore demand supply, maybe there will be more demand than supply unless RBI starts deciding to give. At some point of time, RBI will have to give supply to the market. But so yes, there will be some reduction right now, but the index inclusion just gets you more buyer. Coming once the weightage is filled, it depends on whether EM fund grows in the size, or maybe the FTSE index also includes you. That would be another flow. But once that flows are done, it depends on that size, and of course on India macro, India inflation, the same monetary policy situation. So the interest rate in short term, yes. In long run, it will depend on India macro and inflation.
Lakshmi, what are your thoughts on this? The kind of flows we've already started seeing, and what it could do to cost of capital here in India, because the sense one is getting is that even policymakers work towards getting this thing done and this change done in the larger scheme of things of improving the macros also for the country.
No, clearly, if you are looking at the current scenario, whether it is on the fiscal front, whether it is on the inflation front, or whether it is on the flow front, in terms of creating another additional demand lever, the stars seem to be aligned to ensure that the confluence of all of these factors are set to drive interest rates lower further. Of course, we need to have the icing on the cake, which is the policy making from the central banker, which obviously is impending and may not really manifest itself in a big hurry. But clearly, these are creating the pathway for corporate India to borrow cheaper. For now, obviously, the spreads have widened between Indian bonds, the sovereign bonds and corporate bonds, but the absolute levels are coming down. So definitely from a medium to long term, it's not that it's going to happen today, tomorrow. But if all of these come together in varying combinations, it is set to have a potential lowering of borrowing cost impact for corporate India.
Lakshmi, Jayesh, both of you, thank you so much for taking the time out and speaking with us today. Indeed, a watershed moment, and it begins today.
If you like this video, then like, share and subscribe to ET Now.